So talk to us first and foremost what the relationship with CME is going to be bringing us. How important is it to have a futures market in compute?
It's incredible important. I'm glad that I came in this week. It's an exciting week for the semi industry as a whole. As you mentioned, energy spend, we're probably going to spend over $10 trillion this year. Think about the spot market, from the energy to co-location to the server itself. Everything is at a commodity level. You need financial infrastructure to hedge, to manage your risk exposures. Think about the banks, right? They're underwriting trillions of dollars of loans. How do they manage their risk exposure? How do they hedge their future volatility as compute going online? So from a commodity point of view, think about how oil futures, the wonderful job for people hedging oil fluctuation, especially during the Iran wartime. So it's incredibly important to have futures.
You mentioned the banks, but who else would be the players involved in such a market that need to be hedging right now?
So think about people who naturally long GPUs, so the data center themselves, the neo cloud, design houses, fabs, everyone long GPU exposure. They want a way to hedge it through short futures or put options. Whoever needs compute, just like you and me, like AI startups, they spend billions of dollars on GPUs. They need to hedge their cost as a big component to a line item. Traditionally, SaaS companies, they do not really have a cost line item, aside from people. Now they do, either from GPU level or token level, and it's a big line item coming up.
So the whole push is about transparency and an ability to be able to put these sorts of assets on your overall balance sheet. But then when it comes to transparency, just about the cost of compute. You've already been doing that with the Compute Exchange. What is it that you built there, and who's using that?
It's a great question. So Compute Exchange is a spot market for GPU resources. So we do forward contracts as well as reserve contracts for GPU resources. So a lot of participants, I would say all participants so far, are the underlying consumption layer, so AI startups all the way to the neo clouds. So we're two really big sides of companies. We work with European neoclouds, American neoclouds, Southeastern neoclouds. On the flip side, we have startups and enterprises globally. This is really fascinating. You see how people try to do longer-term contracts because they want to lock in the rate. They don't want the 40% daily volatility comes on-demand GPU pricing. There's other way to hedge that through future options. So we want to make sure we have the right venue for the right use case. If you want to reserve GPUs, you want physical deliveries, go to Compute Exchange. You want to hedge through financial exposures, go to CME in the future.
Tell us about what sparked this whole idea. I mean, for full transparency for our audience, you used to be part of the Bloomberg team. You used to work in this very building. What was it that you felt was missing in the market? Was there literally no transparency around access to compute from one AWS versus a Microsoft offering or a Neo Cloud offering from CoreWeave, for example?
I won't say it's no transparency, but very little. So unless you're in the ecosystem, you're actually in the Neo Cloud transactions, you probably do not know what's the reserve price people paying for longer-term contracts. Think about term structure risk today. And then think about this lack of visibility with on-demand pricing all the way to reserve, which is 3 years, 5 years on deal. And also GPU is not homogeneous products.
Yeah.
You need to normalize it. You can't just say, hey, I'm paying the H100 with certain HBM. You're paying different HBM, different geolocation. We can't just do a simple average. You need indices to normalize the underlying assets to produce as a data that's trackable and representative to the price we are paying today.
Look, we're just talking to Mandeep Singh of Bloomberg Intelligence, who was saying that we need to get to the bottom of NVIDIA's numbers that come after the bell on Wednesday about how much HBM or memory costs are really starting to impact their margin. What is it that you're seeing in your data about just the cost of compute at the moment?
The price are going up. The price going up since December last year. It was pretty interesting. Last year, everyone's talking about, hey, shouldn't compute price always come down and come down to zero by year A? It's not really happening. Supply-demand curve shift every single day. The term structure, the forward curve pattern shift every single day because people have different expectations. There are different bottlenecks come out all the time. Yesterday, last year is fab, and this year is memory, and then going forward, maybe co-location space. So every time is different.
So pricing pressure is there. For you, the pressure is on to get this deal solidified with the CME. You've announced it, but we did say there's regulatory oversight. What sort of hurdles do you need to go through? What sort of questions will be asked?
So we are actively working with CME and a review with CFTC and other regulatory bodies. It is a very traditional data future products. We're not talking anything that's exotic, right? We have done that for oil, for gas, for any other asset classes. So I really don't see a major concern from anyone.
And Going global, how global is the offering that you currently have with CME, or indeed the Compute Exchange? Where else are you likely to push into more broad offerings worldwide?
So we launched GPU indices at Bloomberg Terminal last year, the world's first GPU indices. We cover all prices ex-China. So think about the European from the US, we normalize the geolocation to 1 data points. So anything ex-China is captured our indices. So ideally, around the world, you can hedge that, your exposure with our indices.